Welcome to our quarterly bulletin. My name is Metula Sikakana and I'm the Business Development Manager at Equilibrium Investment Management. It is my pleasure to be hosting you this morning. Before we commence, just some housekeeping. We applied for Continuous Professional Development or CPD points. It is very important to please watch the full session and add your ID to the CPZ section so we can verify your attendance. You may also view this event on the platform at any time until the end of March and receive your CPD points. Our operations team will email you your CPD certificates to you during April. Please also feel free to ask questions in the Q&A section and our speakers will either answer them live or get back to you after the event. You can find more information about our speakers under the Speaker tab located on the top menu bar or if you scroll down. Additionally, if you'd like to download the presentations being shared today, look for the PDF download link. Okay, let's kick off this session. To set the stage, our economist Sanisha Prakisami and economic analyst Tsiamo Masike will dive into the key global and political trends shaping 2025. The economic overview will further unpack the effect of Donald Trump's second presidential term on trade and international relations, political changes in Canada, economic challenges in the Eurozone, and the growth outlook of the US. Closer to home, they will also look at South Africa's progress in making the Most African Growth and Opportunity Act, improving energy policies, and tackling physical issues. These insights will give you a clearer understanding the broader context in which we operate. Over to you, Sanisha and Tsiamo.
Thank you, Matula. Hello and welcome. We trust that you had a wonderful break. As we enter 2025, we are reminded of the revolving economic challenges and opportunities that continue to shape global financial markets. In the next while, our chief economist, Sanisha Prakisami, and myself will be taking you through some of the key economic trends to watch out for in 2025. Sanisha, towards the end of last year, you published an extensive report which looked at some of the more unexpected events that happened in 2024 in the political and economic spheres, such as Donald Trump's resounding presidential victory and the improvement in South Africa's electricity crisis. The report further listed 10 key trends to look out for in 2025 on the local and global front, and most of these were stemming from developments in 2024. The World Economic Forum also publishes an annual report looking at the global risks. The report for 2025 has not been published yet as we film today, but of the top risks that were mentioned in the 2024 report, which of them are likely to persist in the 2025 report?
Thanks, Tsiamo. So the World Economic Forum publishes this Perceptions of Risk survey once a year, and they divide it up into two components. So the first is on longer term 10-year risks, and the other is on shorter dated 2-year risks. And when we look at those 10-year long-term risks, I think many of these are going to populate the table for the 2025 report, such as things like climate change and how that impacts your underdeveloped economies, things like the adoption of artificial intelligence and technology, and the fact that regulation is not really keeping up with that. There is one risk that I don't think is really highlighted on there that I would add, and that is essentially around aging demographics. So many countries around the world have not got proper immigration policies in place, and this is going to hamper labor forces further down the line. Now, when we look at those 2-year or shorter term risks, I think, we really see inflation there quite prominently. But in this world of Trumponomics, I think there is, a view out there that we are going to enter a more reflationary environment. Now, it's true that some of the policies that Trump has stipulated may actually be deflationary in nature, such as deregulation or increasing fracking, which will bring down energy costs. But by and large, things like the immigration policies and tariffs are going to have more of an inflationary impact. And I think the market has already cottoned onto this. If we look at the Fed futures, they have already pared back the expected interest rate cuts for the year. So when we wrote the report, the market was looking for 3 interest rate cuts by the end of this year. At the start of this year, it was pared back to 2 interest rate cuts. And now Fed futures are almost pricing in 1 interest rate cut. So, we are now sitting at the middle of January as we film, but I wouldn't be surprised, in the next couple of weeks that the market could potentially even take out any form of interest rate cuts for the US Federal Reserve. And we know that monetary policy is largely dictated by the United States. And so that means that the prospect for further easing in other markets, such as Europe, may actually be off the table for this year.
Another interesting outlook report is published by the Euro-Asia Group, which was released in early January. But this one focuses on political risks as opposed to the World Economic Forum, which takes a more macro approach. Are there any political risks highlighted in this report that caught your attention and you had perhaps not highlighted them in your 2025 Outlook report?
Well, we always make this joke that when we're talking about the year ahead, it's not very long before you start using the T word, which is Trump or Trumponomics. And so just like any other year ahead report, Eurasia Group's report also focuses on all the ideologies behind Trumponomics. So the trade developments that are likely to stem from there, the change in foreign affairs. So a lot of that, I think we did capsulate quite well in our own report. There are ever 2 risks that I would highlight, such as the ungoverned spaces, which is one of the 10 risks that they spoke about. Now, ungoverned spaces really talks about those areas of the global economy that are left behind as we get these centers of powers emerging. So a great example of this would be Sudan. And the war there started around April 2023, and the United Nations came out saying that around 11.5 million people have been displaced after this war has taken place. And so we are likely to see that more and more, we'll see a global rise in inequality, more poverty emerging. Now, these are things that don't necessarily hit the headlines, but I think this is a key risk that we do need to contend with and governments need to be aware of going forward. The other key risk that I think do underlie our economic forecast, but we didn't really tease it out as a specific risk, would essentially be the AI unbound risk. And this really talks about regulation lagging artificial intelligence and technological advances. And a key example of this would be what happened in Europe over the last couple of weeks, where the underground sea cables were damaged. And that's an example of cyber warfare that has taken place. So I'd say that those risks, we have sort of taken that into account when developing our economic forecast, but didn't really tease it out as specific risks as noted in this geopolitical report.
Let's focus a bit more on Trump. During the holiday break, there were a few legal developments. 1, he was found liable for sexual abuse and defamation in a civil court. 2, there was also a finding of civil fraud regarding his businesses. Moreover, he was the subject of 2 federal indictments, and he was indicted in a state election interference case in Georgia. How will these cases impact Trump's political standing and influence, both in the US and on the global economy, if at all?
Well, we're still expecting that on the 20th of January, we're about a week away at the time of filming, that Donald Trump will take oath to become the next president of the United States. And that does speak a little bit to a 2-tier justice system in the United States, unfortunately, for a number of reasons. So the first, and this is really why I think his case was treated more favorably, even if it was just a normal civilian, probably would have gotten a fine or imprisonment. He is still seen as a felon now in the law's eyes. However, he knew the federal judge that he stood before. He was given the opportunity to appeal to the Supreme Court, of which, 3 of those judges he had appointed. And then lastly, there is also a financial angle here. There was a legal fund that was set up that was both publicly and privately supported for Trump's case. Now, he will be able to still become president and put through all the policies that he wants to. But I think, the real angle here is that there are big question marks around the independence of the criminal justice system in the United States. And it is just yet another nail in the coffin for democracy in my eyes. So if we look at, the chart that we're displaying at the moment in terms of the depreciation in terms of the view on how independent are judges and prosecutors in the United States. This has fallen in the last while. And I think that this will be a continuous trend in the next couple of years under a Trump regime.
Following the US elections, we discussed the likely political and economic consequences of a second Trump term. Since then, have there been any new developments in terms of Trump's foreign policy approach? I ask because it seems that his strong comments about reclaiming the Panama Canal, annexing Greenland, and making Canada the 51st state of the United States has upset many world leaders.
So not uncommon. We've seen that Trump has made many very bold statements, and it always ends up in backlash by other world leaders. And I think that this is a little bit of a negotiation tactic from Trump's side. So I think he sort of scares the opponents, puts them on the back foot, and then gets them back at the negotiation table, and then goes after the goal that he really wants. Quite often we've spoken in these events where we listen to geopolitical strategists out there like John Hulsman, and he's noted that in 2016 there was a reporter that really spoke about how Trump's dynamics played out with his allies and his opponents. And he basically said, that some of his allies take him seriously, but not literally, but the opponents take him literally and not seriously. And I think this is really playing out at this point in time, where they need to take, cognizance of what he really wants to do in the case of these three areas. And so if we look at the Panama Canal as an example, this is a key waterway for goods to be traded from the west of the US to the east of the US without having to go the route via Argentina. So there's an economic consequence that results from that. The Panama Canal was also built by Americans and then sold off at a later point. Now, going forward, I think what he really is after here is to ensure that he can get trade at the lowest possible cost. There's an additional angle, and that's the Chinese angle, because there are Chinese firms that are operating at either side of the canal. And I think what he's really after is to push those Chinese firms out, even though he might not actually reclaim the Panama Canal. The second issue that he spoke about was Greenland. And we know that the Prime Minister of Denmark oversees that region and said that that region belongs to the Greenlanders. However, they don't really protect it in terms of a defense system that's there and present. And I think that the US wants to have some kind of security presence in Greenland. There's another economic angle to that, and Greenland is very rich in mineral resources, especially your rare earth materials. And we've already seen that some Chinese companies have entered into venture capital arrangements in order to extract those rare earth materials, which are crucial for modern tech industries. And I think that's essentially where Trump wants to come in again. The third angle is on Canada. And if we look at Canada's performance, it's actually been quite dismal over the last while. Outgoing Prime Minister Justin Trudeau, during his term, Canada's real GDP per capita dropped from 80% of that of the US down to 70%. And a lot of Canadian growth is still very reliant on the US economy. So when Trump says, they act as a 51st state, he is not 100% incorrect on that statement, because a lot of their prosperity does in fact come from the US economy. Now, I think taking all three of these economies together, we also need to realize what Trump's stance is here. I think he wants to take greater control of the Western Hemisphere, and it is moving against what the Democratic Party did in the last couple of years, where they focused a lot of attention on the war in the Middle East or on Russia, Ukraine. And those regions didn't really have much of an economic impact for the US. Whereas if we look at Greenland, Panama Canal, and Canada, and consolidating that power in the Western Hemisphere, it does tell us a little bit about what Trump's bigger goals are here in this area.
Speaking of Canada, you mentioned Justin Trudeau as the outgoing Prime Minister. Has the news of his resignation surprised the markets? And why is this significant for global politics, especially considering your remarks in your report about the removal of political incumbents in 2024?
We did say that 2024 was going to be a heavily politically driven year. We had 72 elections of which many of the developed markets saw their political incumbents being ousted. And this is a continuation of that trend that we're seeing now in Canada. I don't think it was, a massive surprise to markets given where the popularity vote was for Trudeau. That had grinded all the way down to 16%. And for the Liberal Party, which he represents, went down to about 22%. But I think, what we really need to take away from this is why did the popularity drop to those ultimate lows for the Canadian Liberal Party Prime Minister? And a big portion of this was that he had promoted progressive liberalism 9 years ago when he took the position and promised quite a lot. But many of those policies did not actually come through. Now, we mentioned that one of the reasons that political incumbents were ousted in 2024 was a disgruntled electorate that were experiencing a cost of living crisis. And in Canada's case, it had a lot to do with housing prices and housing costs, as well as immigration. Now, Canada's had big immigration numbers coming through, but citizens felt like there was no coherent policy around that, and numbers were just coming in, crime was going up, fentanyl cases were picking up as well. And I think that really added to citizens becoming very disgruntled with the status quo, with the politicians that were in place. Now, going forward, there needs to be a better response to what the citizens are actually worried about. And in an Angus Reid survey result, they found that 85% of Canadians are worried about the American tariffs that may be slapped onto them in the near future. And if we look at what the University of Calgary has calculated, if these tariffs come through, if the US does indeed put 25% tariffs on Canadian goods coming into the US, that could shave off about 2.6% of GDP, and that could send Canada into a recession. Now, as we look at some other contenders, going into the election later on this year, which is in October of 2025, it looks as though the other contenders are factoring in things like tariffs and what that means for the Canadian economy. So even though, with Trudeau stepping down and there's some other names that are being flouted, such as Mark Carney, who's the former governor of the Bank of Canada, even if we do get another replacement, it's quite likely that the Liberal Party won't survive the October 2025 election because they're not quite focusing on the real issues at play, which has a lot to do with the Trump policies.
As we've said before, Trump's harsh comments are a strategy to negotiate trade deals. But now, it looks like other options are being considered. For instance, can the rule on undertaxed profits be used by the Eurozone to prevent an economic conflict with the United States?
Definitely, but I think this strategy is going to be deployed elsewhere as well. So if we think about China, we saw that Trump came out with very bold statements in terms of the tariffs that he wanted to apply to Chinese goods coming into the US economy. But again, I think that is a tactic to get China at the negotiation table and say, maybe we'll lower these tariffs, but then you need to lower the concessions on American companies that are operating in China, as an example. Now, with this undertaxed profits rule, there was a pact that was signed by a number of countries, including South Africa, at an OECD meeting earlier on in January this year. And what that basically says is if you have American multinational companies operating in different jurisdictions and paying less than 15% tax, that jurisdiction can then levy a top-up tax. Now, for Europe, what they could potentially say, if they get all their leaders to agree and be on the same page with this, they could then go to Trump and say, okay, maybe we won't do the top up, but then maybe you don't give us such heavy taxes on the European imports that are coming into the US. So definitely, I think, this year we're going to see a lot of bargaining around how trade negotiations are dealt with.
The Eurozone appears to need to focus on maintaining growth in exports due to the domestic, economic, and political challenges it faces. What are the growth prospects for the region this year?
Well, we often talk about US growth exceptionalism, where growth is expected to do really well in the next while for the United States. But the counter to that is that other developed market economies may actually suffer a further economic blow. And I think that the Eurozone is going to be one of those. So we're looking for growth sub 1% in that region for the year. And that's because some of their major economic powerhouses are not doing that well. So if we think about where we can potentially get some growth from, there might be some relief on gas prices and energy prices as those come down. And we know that that took a huge chunk out of consumer pockets over the last while. But the counter to that is that if we look at Germany as an example, they've been on the back foot with technological advancement and adaptation. And we've seen that the manufacturing sector has suffered as a consequence of that. They also have major political issues at play right now. And so if we look at Olaf Scholz, who is their chancellor since 2021, he's not sitting in a very pretty position right now because the electorate there has also become quite grumpy that he's in place and hasn't actually adequately, fought for what citizens want in Germany. If we look at who's likely to take over from there, again, we've got an election taking place on the 23rd of February. It does look as though the center-right, center-left alliance, the CDU-CSU, is the front runner to take that position. And as a close second, we've got the Alternative for Germany, which again speaks to the rise in populism across many of the European counterparts. If we look across the European counterparts, there are a number of economies that either have caretaker governments or no government really in place right now. I think there's 6 at the moment that are flagging. And that shows that there's no real leadership taking place in Europe. Whereas even it might not be the leader that we want in America, but we do have Trump at the helm there. And so that is likely to keep, the dollar in quite a strong position relative to the euro over the next while. Also in Europe, we've got France, which is the second largest economy after Germany. And there we also have, a lame duck president with Emmanuel Macron in that position. And even though he's only expected to do an election in 2027 and he can't stand for another term, I do think that all the pressure on him might actually bring that election forward to this year. And, in the wings, we've got the far-right leader of the National Front, Marine Le Pen, who looks ready to take up that position. So I think, we're going to see a lot of political issues coming out of Europe and European growth remaining on the back foot.
As we like to do, let's bring it back home. The African Growth and Opportunities Act, also known as AGOA, was one of the key concerns for South Africa's economy under a Trump regime. Luckily, it was announced in late December that South Africa secured AGOA benefits for another year. However, challenges in this regard remain, because to obtain an extension beyond 2025, the legislation must be approved by the US Congress, where Republicans hold the majority after Trump's victory. Additionally, South Africa's external trade faces challenges due to growth below 1% in the Eurozone, as you've mentioned, and China's growth is expected to struggle to exceed 4.5% this year, especially with the ongoing trade between China and the US. Aside from external trade, what does South Africa's growth outlook look like for this year?
We are estimating that growth will pick up from below 1% last year to somewhere between 1.5% and 2% for this year. And I think, one of the biggest game changers in this regard has been the improvement in energy supply. And so if we look at what the South African Reserve Bank were estimating at the time, at the beginning of the year of 2024, they estimated that load shedding would shave off about 0.8 percentage points of growth, and then they revised that lower to 0.5. Now, we haven't had load shedding since the end of March, which means that 0.5 could even be lower. We also saw over the course of the holidays, we had Coburg Unit 2 being synchronized to the grid. So that adds another 930 megawatts of energy capacity to the system. So that's on the energy side. If we look at where growth is likely to come from in the next while, and we chat a little bit about the consumer, for household consumption, we think that a bit more growth will come through with real wage growth improving, because inflation is likely to average at a lower 4.2% this year. We think a little bit of employment growth might help. We think an additional 2 cuts in the interest rate. And again, I don't think we're going to get much more than that, given that worldwide we've seen that interest rate cut expectations have now been severely pulled back on the back of Trumponomics and what that would mean for a reflationary environment. There's also this additional angle of the early retirement withdrawals, and we saw that pension reform coming through in September of last year. The South African Reserve Bank were looking for around 40 billion of withdrawals in the last quarter for 2024, but they since revised that to 51 billion. And we think that quite a bit of that is going to end up again in consumption. For fixed investment, I think what we really need to see here is higher sentiment now starting to translate into broader-based improvements in fixed investment. So a lot has come through from renewables, and we've seen that the energy regulator of South Africa has suggested that the pipeline for renewables is very strong for this year and next, but we need to see that businesses start to actually invest more in South Africa. If we look, for example, in other parts of the economy, we don't think a lot is really going to come through from the government side of things. We think that the budget is still under, significant stress there. And as you've mentioned on the trade side, there are a number of headwinds. Now, I think what was quite nice at the end of 2024, we got an announcement from Standard & Poor's that, surprised markets a bit more favorably. I think people expected that announcement to come, but a bit later, maybe 2025. And they announced that they're going to lift the outlook on South Africa from neutral to positive. And I think that's a step in the right direction. But again, for us to see an actual rating upgrade, we do need to see that more reforms actually come through, not just on the energy space, but also on logistics and water and a number of other areas in the economy. We also saw Moody's taking that sentiment early on in this year, that they feel quite optimistic that South Africa has started this implementation of reform process. But of course, we know a lot more needs to be done. The other angle that I think, ratings hinge on is fiscal management in South Africa.
You mentioned that better fiscal management is important to South Africa, and I couldn't agree more. Going into the national budget, which will be tabled on the 19th of February, there are 3 things I worry about. 1, the size of government's wage bill, especially given the ongoing negotiations. A decision on the basic income grant, and the financial viability of our state-owned enterprises. What are your thoughts on these 3 risks to the fiscal outlook?
Let's take them one at a time. So if we take, the government wage bill, I think we do need to give Treasury credit where it's due. And we have actually seen that, the size of the wage bill relative to non-interest expenditure has come down a bit. But of course, it remains quite sizable. And now, during the negotiation period, we've seen that government, over the course of December, lifted their offer from the low 4% to about 5%, but the Labour Union still wants 6%. So there is still a gap there. Treasury has said they could plug the gap by having early retirement taking place. We are still a little bit skeptical on how much that can actually, counter a larger wage bill, but we're yet to see on that one. What I think will help is if they do bed down a 3-year multi-year wage agreement, because it does mean, that we've got some certainty in the fiscal process for the next 3-year period. The second issue you mentioned is on the basic income grant. I do take a little bit of relief knowing that Treasury has penciled in an allocation for the social relief of distress grant extending into this fiscal year and the next. But of course, there are question marks around whether that is going to be changed into a basic income grant, whether that 350 Rand per recipient per month is going to be more, and whether more people are going to be eligible. And of course, that will push up the amount that government would then have to spend on that. And then the third element that you mentioned is, the ailing financial position of our state-owned entities. With regards to Eskom, even though they did get quite a chunky bailout from National Treasury already, we are quite worried about how they're going to pull out the distribution leg of Eskom. And the key worry here is that municipalities, as of November, according to the Business Day, owe Eskom about 95 billion Rand. So, that is quite a chunky number that hasn't yet come through in terms of non-payment. If we look at Transnet, I think, we've seen some positive developments with regards to the ports, particularly in Cape Town. One of the liquid bulk terminals was sold off in a 25-year lease to a private company. But then on the other hand, we've also got the Durban Port Terminal, where privatization plans here have been delayed. Transnet also, over the course of the holidays, came out with their statement, and that basically showed us that they made a loss of 2.2 billion Rand for the first 6 months of their financial year 2024-2025. And this is, even with some improvements coming through on railway volumes and some port alleviation constraints. So that tells us, that the security issues with Transnet are still there. The ailing infrastructure problems are still there. And that backlog, I don't think we have a firm estimate of what it's going to take in order to resolve Transnet's problems and what government would then have to pay out in order to resolve Transnet's issues.
Sure. That gives us a lot of economic food for thought as we dive into 2025. Thank you for joining me today, Sanisha.
Always great to dissect the economy with you, Tsiamo. Thank you.
Thank you for your time today, and we wish you all the best for 2025.
Thank you, Sanisha and Siamo. Next up, we've got Lejda Bargjo from Robeco Asset Management, who will go through the opportunities in 2025 and how indexing strategies can complement your traditional portfolios. Welcome, Lejda. We look forward to hearing your insights.
Thank you so much, Metula. Hi, everyone. I am Lejda from Robeco, the underlying manager of the Curate Global Sustainable Equity and Curate Global Emerging Market Equity Funds. Thank you to Metula and the Equilibrium team for having me today to highlight how an enhanced indexing strategy can complement your traditional portfolio, adding significant value over the traditional passive allocation. And then one question that probably you all have, like myself, it is, what does keep investors up at night? How is that reflected on your valuation, on what themes dominate the headlines? We often see there artificial intelligence as being one of the main topics over the last 10 years. It has really been up and rising. Next to it, of course, you see the Magnificent Seven, especially dominating in the US market. Valuations are quite high at the moment. We see a huge concentration risk in the US and in developed markets. Developed markets in US, therefore, hence the Magnificent Seven. You probably also developed markets versus emerging markets. Emerging markets also an emerging topic. How to deal with that? How does emerging markets come with? Because it comes with different currencies, currency risk, geopolitical risk. How to invest in those markets is also quite key. So we've also seen quite the rise of passive investing in the last years. And then the question remains, how much is it left then for an active investor? Because we do to see that it's of course crucial to see what such strategy can offer, and hence can they be superior to passive and complementary, of course, to fundamental strategy. Keeping in mind the risk and returns. And through all of that, we've seen in the last year the rise of active investing, calling it the demise of, so to say, active investing. And if we look further on active investing per se, on the right-hand side, you would see active, actually, investors, like the funds allocated within the active strategy, are diminishing with time. That's the blue line, and the lila line would be more the passive investing that has been increasing with time. But how has the performance in such markets been? Active versus passive. We've also seen on the left-hand side, if you see the table, here is just an overview of different markets, as well as different performance over different periods. And we see that the percentage of funds which have underperformed the index over different periods of time, let's say on the global funds, the top line, it is on a period over 3 years or up to 10 years, it is actually above 80%. And that's quite large. We did talk a bit about active manager. Lots of active managers are underperforming after cost. And if I also think per se of a passive manager is also guaranteed underperformance after cost. Hence, it's very, very important to find a way on how to invest in a in the best way to actually have a potential for outperformance. In the charts here, we've seen of course the increase of the concentration risk in the last 10 years. Trend driven by of course, probably the AI frenzy, were also the main topics we touched base in the beginning. And if you're an active manager, how do you make it? Or do you run the risk of concentration risk? In developed markets per se, that's the left-hand side graph, we see the S&P 500 by company. The chart starts in 2015, and you see that throughout time. And what we do notice is that this fantastic or magnificent seven, they have actually taken quite a big chunk of the market within the S&P 500, and this has been increasing gradually with time. Quite a high concentration. This rally have also led us to quite high valuation levels over time. If I compare US also to other regions, we do see that US is relatively expensive, so to say, versus the other region on the right-hand side chart. Have the US markets, the European, Asia Pacific, and emerging markets of today's values as well as the median values. And we do notice that the US market has been actually quite concentrated and very much more expensive than the others. Already alone this magnificent seven stocks, they make in terms of market capitalization after the US, they are alone, they're actually the largest ones. Another voice that we've seen in the last years is also the topic when it comes to the trilemma: return, risk, and sustainability. When it comes to return, risk, and sustainability, our main goal is to add return, reduce risk, or better saying, have a better risk-adjusted return. And therefore, we've seen a backlash against sustainable investing, especially in the last year, since Trump was the winner from the election, and since he's been in power, one of the earlier last month, and then we saw one of the first things he did is the US taking US out of the Paris Agreement. Therefore, the question of sustainability is what sustainability is. Power is now to power. So the complexity of such topic, the way to go about sustainability in our view is actually to be consistent, repeatable. The key is to focus and to see on how we can actually solve this trilemma when it comes to risk, return, and sustainability, of integrating such measures with already on how to integrate them within our model. And that's where we're quite strong in it, because you can improve SI but not at the cost of alpha. I mean, we go in a bit within the model per se, but it is possible to get an extra alpha without taking without it costing more. Therefore, it is very very important also in such markets to be focused. How do active managers? So if I mentioned already how to solve such dilemma, or how to dissent from voices on sustainability growing louder. Therefore, we need to see how active managers can win against such a backdrop. Therefore, it is quite important to have a very disciplined and proven investment process. The way to go about it is basically being, as I mentioned, consistent and repeatable. So very disciplined, very proven. This way, it guides investors towards fundamentals, to adapt to the changing environment, which is one of our key developments as well, and incorporating forward-looking and proven insight. And what would I mean with that? Because it's very important to adhere to evidence-based research approach to identify factors that are rewarded with superior risk-adjusted performance. To use basically all the different research, academic literature, alternative data, experience, and continuously developing and recognizing that the environment we operate is not a static one, but may evolve with time. In particular, markets and human behavior. Hence, it is important that the model need to be adapted to such changing dynamics. That comes with the forward-looking signals. Efficient integration of sustainability. We need to also here make sure that we have that already integrated in the stock selection process, and we need to be aware of the robust risk control and be very benchmark aware. Why? But do I want to mention it? It's very important to see that really it is very risk aware, and we are the strategy is aware of the risk controls and of course of the benchmark. It is often see that as an alternative to passive. It is an enhanced indexing strategy, and therefore being also in here, it's very important to be consistent, repeatable, and have robust risk control and benchmark awareness. Why are we good at it? What are our strengths? The European roots and a meritocratic culture, got a flat structure, very healthy competition of ideas. We have rich quant heritage, more than 30 years of pioneering research, which has facilitated smarter investment solution, what we see today as well. We have one clear investment philosophy, which is based in blending economic intuition, evidence, and prudence for robust, cost-efficient strategies. We are innovative. Proprietary signals, portfolio construction algorithm are key. A lot of our alpha comes from such signals. And being live for 30 years, developing and enhancing our models with a clear investment philosophy has enabled us to actually gain the proven track record in both developed and emerging markets in over 2 decades of risk-adjusted return, helping our client to meet long-term goal while still being quite near the index. I've already mentioned couple of times enhanced indexing as being an alternative to passive investing. And why do I say that? What is then meant with that? Enhanced indexing enhances an index by getting exposure to factor characteristics. The index weights are the starting position, but they are adjusted according to the relative attractiveness. And the relative attractiveness, basically, when I mentioned there, is based on our own stock selection model. The attractive constituents then would get a higher weight, while the unattractive one lower weight. But if I see it all in all, what makes such a strategy better than passive investing? Broad market exposure and high liquidity. You'd find the same as in passive investing. You'd have predictable risk return profile. You get the same thing with Robeco's enhanced indexing strategy. Got a low cost strategy. But what do you get in addition to that? Got better return profile. We've got a much smarter company selection and improved sustainability. The better return profile, of course, after costs, we have a control risk, benchmark aware. If with a passive investing you're guaranteed an underperformance, here you've got a way better profile when it comes to long-term risk return profile. We use our own stock selection model, and of course, sustainability is key. And it is improved and integrated within our stock selection model. But how does a stock selection model works? This is quite a simple, I'd say, pie chart where we are looking with our proprietary stock selection model to find the attractive, revalued, profitable companies out there that are getting increased attention, exhibiting also short-term trends. So how does a super stock looks like? We integrate factors like value, quality, momentum, analyst revisions, as well as short-term signals. So the super stock has the characteristics of has basically good value stocks that trade at an attractive valuation, and it scores stocks on different diversified valuation factors, such as would be the price to fundamentals. And when I think of also in here, we do see different enhanced definitions of the value factor as well, and signals within the value factor. Like one of them would also be enhancing, and we call that the decarbonization of value, finding the best stocks that are less polluting. We want quality company, therefore we search for companies that have a solid profitability profile. So stocks with supportive and sound fundamentals that tend to outperform those with weak fundamentals and the market as a whole. Also here we look for a multidimensional view of quality that incorporates profitability, earnings quality, and investment related factors, in addition to also here some sustainability factor already integrated within the factor itself. On the right-hand side of the pie, we do see price momentum. Stocks with positive price momentum, which we define as stocks that have recently entered a relative positive trend. They tend to outperform those with a negative one. We'd have next to the academic definitions of price momentum, we use also other advanced, for instance, residualization technique, which use stock-specific returns adjusted for other characteristics. This is important, especially when we see a sharply reverting markets, especially if it goes from up or down. Another signal, which has been very good to us over the years, has been the analyst revisions. Analyst revision factor have become more positive about company earnings. Stocks with recent upward analyst revision tend to outperform those that receive downward revisions. To capture this factor in the best possible way, also we focus on multiple analyst revision and apply also here techniques to address the tendency of analysts to be overly optimistic over future earnings growth, prospects of growth stocks as well. And at the bottom, lastly but not least, are the short-term signals. The short-term signals are stocks with favorable short-term dynamics tend to outperform those of negative short-term dynamics. We incorporate such signals that aim to exploit the short-term stock price reversals, short-term sentiment, flow data, like for instance, short selling metrics, seasonal dynamics, or short-term return patterns. So this figure shows how an index can be enhanced by focusing on stocks that exhibit certain proven characteristics. Hence, this is our enhanced indexing approach by integrating value, quality, momentum, analyst revision, and short-term signals. We have developed our model, of course, with time, and our definitions have been improving the risk and return characteristics to adapt, as mentioned previously, to the changing dynamics as well. Therefore, I will just touch base on a couple of such enhancements. When it comes to value, we want to avoid the value traps. Therefore, I mentioned the carbon footprint, so enhancing decarbonized value factor was one of the signals that we developed in the year 2019. These are just some examples of it. On the quality, we also there we used academically backed quality definition 2016 and sustainability theme quality part of it in 2020. The residual momentum was developed in the year 2012, but we also use new sentiment and credit momentum too. Analysts' revision could also be biased. Therefore, we also adjust such raw revisions for behavioral biases. And lastly, we also incorporated, of course, over time and have developed the short-term signals over years as well. So the model is really future-proof. We have used such factor definitions and we developed those further to improve the risk-return characteristics of the funds. These were just some of the examples, and I now want to give you want to focus basically on a bit more on the next generation, on that last bullet we have in here on the short-term signals, and also more the next gen quant research of it, next generation quant research, harnessing AI to fortify our time-tested investment process of 30 plus years. These are just, I won't go through all of them, but these are some signals in which we have enhanced our model with a machine learning signal, like, for instance, the interactive reversal detecting short-term reversal effect by also linking it to the news flow, or in the natural language processing signals, you could do a lot with that. News sentiments was one example where it identifies basically momentum based on news flow using alternative data sources. Founder C-suite was a signal we developed in 2023, where it is part that of the more the quality basket, which establish the presence of founders in management and or the board, and is linked with long-term growth. And more specifically, I on the NLP, an example I'm giving here is listening in between the words of an earnings call, the Q&A. So what's the rationale behind it? We want to see if the unscripted section of earnings calls are more informative than scripted ones, because usually executives have the tendency to deliver carefully crafted statements. Questions from analysts reflect objective perspective, and answers from executive unwittingly reveal more details. And establishing a firm, so link between questions and answers leads basically to more insight. I find it personally very, very insightful. Signal is stronger when positive, or negative question elicited responsive with very similar tone. So for instance, if you'd see at a, we can differentiate the underlying data, we gain substantial performance improvements. So the scripted presentation, section A, company present would be like, for instance, a company presentation is in that case of the least value. That's the lila line. Questions in the Q&A section, which is unscripted sections, so the B and the C. In this part, the orange and the blue line are the most valuable part of the earnings call. So on section B, you can get better insights from the presentation, and on the section C, so the analyst then would ask more questions. It holds even more potential. So these signals, of course, are used based on our model. There is more information in the question than basically in the answer as well. So by establishing a strong connection between the question and the answers, we can introduce a new and compelling dimension to the signal. So notably, when the sentiment of the question and answer aligns within the context, it imparts more insightful information. This is just one of the many examples within our research that how we have been developing the model with time. We talked about the market, why enhanced indexing is so important, how the model works, some example or more example, like one detailed example on one of our signals. And now I want to just go within our enhanced indexing portfolio construction. So on both cases, the Curate Global Sustainable Equity Fund as well as Curate Global Emerging Market Fund will start with the benchmarks, so MSCI World or MSCI Emerging Markets, which we have all the stocks in the universe, 2,000 for the global sustainable and 1,600 for the emerging market equity fund. Our goal here it is to give you the best information ratio out there. Therefore, we manage it with an ex-ante tracking error long-term average of 1.5% when it comes to the Curate Global Sustainable Equity Fund, and 1.2% for the emerging market equity fund. To have we have a control risk, and we make sure that that's also, like in this case, 1.5 and 1.2% respectively on global sustainable and emerging market, very near to the index. Hence, in the global variant of it, we need to be sure that we are sector industry neutral. That's why we deviate when it comes to sectors industry between -2% and 1% on the overweight side. On country and region, that deviates to -1 to 1%. On the emerging market case, talked about country, currency risk, geopolitical. That's why country neutrality is here key. We don't want to take any country bets. We want to be in line with the index, and hence we have the deviations within the country region that are ±0.3, and when it comes to sector industry to ±1%. On the global sustainable equity fund, of course, make sure to integrate our sustainability metrics tool, which would be at least 10% better or lower ESG risk rating than that of the benchmark, a carbon footprint lower than the index of -30%, water usage and waste generation should be lower than that of the benchmark by 20%, and we do exclude a -3 and -2 SDG rating. This is more sustainable focused fund, and the emerging market one is still sustainable in the terms, because all the sustainability criteria I mentioned are included, but they should be just better than that of the index. Going further, so this has been the portfolio constructions. Now we want to see how does that all translate into numbers. How has that performed since the start of the two Curate funds? So we start with the first one, the Curate Global Sustainability Equity Fund in US dollar. The start of it was in May 2020. We have, if you remember from previously, we had an information ratio target of over long term of 0.65. So we're very happy to see that since inception, we could deliver an information ratio of 0.85. And we could deliver since inception an outperformance relative to the index of 1.34%, gross of fees annualized over since the start of the mandate. So the model does what it does, and it's still quite near to the index. On the emerging markets portfolio of Curate, we do see similar or even better results when it comes to the alpha. Also started in 2020, in March 2020. We could achieve here since inception information ratio of 1.83 with a tracking error of 1.34, and we could deliver an outperformance of 2.3% gross of fees since inception. We have to look at it, of course, from a long-term perspective, but as you can see, the strategy does what we expect from it to do, and it does give us a much better risk return profile than a passive solution would be. And the risk model, the stock selection model, our models per se and Robeco is basically the best for implementing that, because the results do speak for itself. So offering better risk adjusted performance over time.
Thank you, Lejda. Let's transition to our next speaker, Rupert Gessing, a portfolio manager at Equilibrium Investment Management, who will provide an update on our Equilibrium Standard Solutions. He will further discuss an outlook following the election, focusing on the current optimism as well as the challenges posed by inflation. Rupert, the floor is yours.
Thank you, Metula. Good day. Global and local markets delivered another year of strong returns in 2024. Continued US strength helped developed market equities, as measured by the MSCI World Index, deliver total returns of 18.7% in US dollars for the year and 21.5% in rand terms. SA equities, as measured by the CAPSWIX Index, ended the year up 13.4%. In fact, all asset classes, both local and global, with the exception of global bonds, delivered positive rand returns for the year. The market returns engine was indeed firing on all cylinders. Overall, the final quarter of 2024 finished on a weaker note though, after a sharp sell-off in December following the American Federal Reserve Bank's cautious outlook on interest rate cuts for 2025. As we've come to see in recent years, where markets seem to be more and more sentiment-driven over the short term, the negative change in outlook dampened the positivity seen in November when Donald Trump's victory drove global equity prices higher. The November rally, led by the US market, reflected investors' view that some of the potential new Trump administration policies, such as corporate tax cuts and lighter regulation, could boost US growth. That positivity changed quickly as the Fed turned more hawkish amid the persistent threat of higher inflation, supported by the possibility of the implementation of stricter tariffs. They scaled their projections for rate cuts down to 2 for the year from the 4 they previously anticipated. This was also manifested by the central bank's decision to keep rates unchanged at the first meeting of 2025 in the last week of January. Federal Reserve Chair Jerome Powell reiterated that there would be no rush to cut them again until inflation and jobs made it appropriate. However, US equities still managed to end a turbulent quarter in the green despite the sharp decline in December, with the S&P 500 up 2.3% in dollar terms. These returns continue to be dominated by a select few large technology stocks. The following chart illustrates to what extent US equities, specifically the large technology stocks, continue to drive global equity returns in 2024. As one can see, the US completely dominates. Although expensive at an overall level, we are starting to see a slight rotation in US equities away from the select few tech stocks. As an example, and according to research done by JP Morgan, the Magnificent Seven are expected to report earnings growth of 23% for the last quarter of 2024, compared to 9% for the other 493 stocks in the S&P 500. The following chart illustrates the estimates towards the end of last year, with a difference of 29% for 2024, reducing to 12.8% during 2025, and then normalizing over the following years. Of course, we've come to see in recent weeks that it's not only earnings that the market needs to be concerned about. The arrival of DeepSeek, a Chinese AI startup, shook the foundations of US AI stocks, disrupting the whole business model and triggering a significant re-evaluation of AI valuations due to its significant increase in efficiency and cost reduction. As DeepSeek starts making inroads in the AI world, it is a stark reminder of how dynamic the technological investment environment can be. But back to the Magnificent Seven and the expectations around earnings normalization before the DeepSeek disruption. If one considers the difference since quarter one of 2024, when the Magnificent Seven earnings grew by 50% and the other 493 stocks in the S&P 500 contracted by 2%, we are definitely starting to notice a rotation in US equities, which could bode well for the market overall. But there is still a considerable amount of risk attached to it. Now magnified by the arrival of DeepSeek, if one takes into account the sheer weight of these tech giants in the S&P 500 and the MSCI World Index. On the other hand, the United States and so too many other countries have a debt problem, and it's growing by the minute. US gross federal debt is now at an all-time high, and the highest it's been since the Second World War, sitting at over 118% of GDP. As we can see, America never really recovered from their debt burden after the global financial crisis between mid-2007 and early 2009, which was then only made worse by the COVID-19 pandemic in 2020. The era of expansionary fiscal policy and cheap money to mitigate the shocks of these events unfortunately took its toll. I found the numbers in an article that I read recently staggering, and I thought it's worth sharing. America has $35.8 trillion worth of debt. This is roughly $106,000 per citizen or $272,000 per taxpayer. Now, 35.8 trillion is a very big number and one that is difficult to comprehend. Consider the following. If you stack $100 bills on top of each other at 1 meter high, roughly the height of a chair, you will have $1 million. At 1 kilometer high, which is just higher than the world's tallest building, the Burj Khalifa in Dubai, you will have $1 billion. And at just over 1,000 kilometers, which is more than twice the distance that the International Space Station is from Earth, you will finally reach $1 trillion. Now multiply that by 35.8 and you have a stack of $100 bills that is 36,300 kilometers high. You are now approximately 1/10 on your way to the moon. And this tower also keeps getting higher as every 30 seconds American government debt grows by $1.4 million. So the Trump administration will have their work cut out for them. Tax cuts are certainly not going to do anything to plug the debt gap, but his pro-business and manufacture in America stance could bode well for the American economy and ultimately the stock market, and it could boost US government revenue. On the other hand, it could also enforce sticky global inflation. It's definitely not going to be smooth sailing, as the rest of the world isn't going to sit by idly and watch this plot unfold over the next few years. Speaking of the rest of the world, a late rally in Chinese equities coupled with strong results out of India helped to offset some of the losses in emerging markets. the impact of increased volatility was still felt as emerging market equities, as measured by the MSCI Emerging Markets Index, was down over 8% for the quarter. The US Fed's lack of urgency to cut rates, together with signs of sticky inflation, meant that US bond yields rose across the Treasury curve over the quarter. Global bond markets followed suit, and the World Government Bond Index ended the quarter down over 5%, for a return of minus 2.9% in US dollars for the year. The US dollar also continued its recent strong run, helped by the Fed's hawkish stance. The rand weakened by over 9% against the greenback in the fourth quarter, in solidarity with most major currencies, as markets priced in stronger US growth and fewer rate cuts. This helped to boost global equity returns in our Equilibrium range of portfolios, and also to offset some of the negative returns from global bonds and property. Back home, 2024 was a good year for South Africa. We got welcome relief from load shedding that was crippling the economy, saw a positive election outcome, and the prospect of better economic growth. This progress is reflected in buoyant returns from domestic assets, with the capped shareholder weighted index returning 13% for the year. SA equities came under pressure in the fourth quarter, however, as December marked the third consecutive month of declines, and the index ended the quarter down 2.1%. Global headwinds were amongst the main drivers behind the local risk-off sentiment, particularly in the US, as again, the uncertainty over monetary policy and inflation concerns weighed negatively on investor confidence. Now, from a sector perspective, returns reflect a strong contribution from domestic shares. The financial index ended up 22% for the year, but down 1% for the quarter. The industrials index up 18% for the year and flat for the quarter. Resources lagged though, declining a meaningful 9% for the quarter as well as the year. China's shift to less infrastructure-heavy growth remains a headwind to demand, contributing to a weaker outlook for many commodities. Overall, the improved South African outlook drove the expansion in valuations for domestic equities in 2024, though the asset class remains attractively priced. Earnings growth will be a key driver in justifying the expansion, and the resilience of local businesses in sectors such as banking and consumer staples can continue to drive equity returns. SA equities still trade at a large valuation discount compared to the rest of the world and its own history. Assuming a conservative 19% earnings growth in the next year, the SA equity market is now half a standard deviation cheap against the average since 1999. Also, the SA equity market remains underowned, so any uptick in demand will also support further positive returns. While still being the best performing asset class for 2024, listed property didn't manage to escape the negative turn of events during the last quarter, with the all property index down 0.4%, though still up a significant 29.8% for the year. It is worth noting that the strong recovery during 2024 contributed meaningfully to returns in our Equilibrium portfolios. In line with global bond markets, SA bond yields rose in December, resulting in negative returns for the month, which is a rare occurrence as it was only the fourth time in over 2 decades that the asset class had negative returns for the month of December. However, healthy returns of just over 3% during November offset losses, and local bonds still managed to end the quarter in positive territory, up 0.4% for the quarter and 17.2% for the year. The South African Reserve Bank, or SARB for short, continued its rate-cutting cycle over the quarter after lowering the repo rate by 25 basis points to 7.75%. In a decreasing interest rate environment, local cash still delivered healthy real returns, up 2% for the quarter and 8.5% for the year. From a portfolio perspective, we maintained a mostly neutral tactical exposure to all asset classes, except for local equity, where we had a neutral to overweight position during the last quarter. The impact of negative returns from the asset class, fueled by increased global volatility, was offset by positive returns from our fixed income and cash exposure, though marginal. The significant weakening of the rand against the US dollar during quarter 4 of 2024 offset losses from global bonds and property and supported global equity returns. Ultimately, it meant that rand returns from these asset classes were still positive and contributed to the performance of our portfolios. As the saying goes, diversification is the only free lunch in investing, and our portfolios are testament to this. they still delivered healthy positive returns ahead of or in line with both their benchmarks and peer groups, with the exception of the income portfolio that slightly lagged the benchmark for the quarter. The income portfolio delivered 1.9% during the quarter, while the conservative, stable, moderate, balanced, growth and unconstrained growth portfolios delivered 2.24, 2.3, 2.25, 2.27, 2.41 and 2.28% respectively. The portfolios also had a very strong 2024 with excellent performance for the 12 months to December, being ahead of their respective peer groups and benchmarks, with the exception of the income portfolio that again slightly lagged. Staying invested and following a disciplined approach during good times and bad times is always going to pay dividends in the long term. And the strong short-term performance has also meant that the annualized numbers over the respective minimum time horizons also improved significantly. All the portfolios, with the exception of the growth and unconstrained portfolios, are also ahead of their respective benchmarks over their minimum recommended investment horizons of 3, 4, 5, 6 and 7 years. So what were the key drivers of performance in our portfolios in the last 12 months? Using the Equilibrium balanced portfolio as a proxy, the attribution table indicates that performance was mainly driven by our strategic asset allocation. Tactical asset allocation detracted slightly due to an underweight global equity position that we carried into 2024, but manager selection contributed positively to performance, adding 0.5%. Overall, it was a year of strong returns and the portfolio outperformed both the CPI plus 5% benchmark and the peer group. Looking at the drivers of performance from an underlying manager perspective, we can see that the Forward Equity Fund and the Blue Alpha BCI Equity Fund were significant contributors to performance. Pleasingly, since its introduction into our model portfolios in the middle of 2024, the Curate Momentum Sustainable Equity Feeder Fund has also contributed positively from a manager selection perspective. Detractors from performance were the Visio BCI Unconstrained Fixed Interest Fund and the Coronation Global Emerging Markets Flexible Fund that had a difficult quarter and underperformed the MSCI Emerging Markets Index during the last quarter and year. Turning our attention back to the Visio BCI Unconstrained Fixed Interest Fund, I would like to remind you that the fund is much more conservatively positioned than the Momentum SA Flexible Fixed Interest Fund, which we pair it with to get our fixed income exposure. During periods when bonds outperform cash, as we saw during 2024, relative to the All Bond Index, we expect the Visio fund to underperform. This is intentional as it's an integral part of our portfolio construction and diversification process. In closing, from a tactical perspective, considering valuations as discussed earlier, we've maintained our slightly overweight local equity position. We've moved to a neutral to underweight position in property amongst the local asset classes. This is the one area where there are conflicting fundamental and valuation signals. The recent re-rating in share prices has pushed counters in the sector to now trade at significant premiums to their historical averages. We've maintained our neutral position in local bonds. SA government bonds continue to offer very attractive yields based on their most recent inflation releases, particularly against developed market bonds, but also the emerging market bond peer group. On the global side, we've maintained our neutral position in all asset classes for global equities, as long as the current positive correlation of economic surprises with US equity prices holds and a strong US economic growth narrative continues, there should be support for higher equity markets via positive profit expectations. Historically, US equities have performed well during US rate cutting cycles that were not associated with recessions. However, challenging valuations will possibly constrain returns going forward, but the rotation away from the tech-heavy giants can also support the asset class. Thank you.
Thank you, Rupert, for that insightful advert. It is reassuring to know that these solutions are managed by such a competent team of investment professionals. It's great to hear how our standard solutions are positioned to perform well in the current market environment and deliver strong returns in the next quarter. Now, let's shift gears and turn our attention to our colleagues in London. Richard Studley, Senior Portfolio Manager at Momentum Global Investment Management, or MGIM, who will provide an analysis of the post-US election landscape and offer a wide lens outlook for 2025.
Thank you, Metula, and thank you everyone for joining us. Okay, here we are in 2025. As of November, we now have a highly unpredictable 47th president of the US. Said individuals firing off social media messages, firing off more than 100 executive orders on his first day in charge. One would be forgiven for thinking that everything has changed and we need to rip up and everything can start again. I would suggest to you that in fact not that much has changed. It rarely does in fact. Okay, so as it is a quarterly feedback presentation, let's jump straight into the quarter. For Rand investors, thinking about that period between September and December 2024, Rand investors were insulated from what was actually a pretty weak quarter for global asset classes. They were insulated by, you guessed it, the nigh on 9% depreciation of the Rand against the dollar. So that helped your Rand returns, but here we're looking in purely dollar terms, and you can see it was a pretty weak period. Global property securities down nearly 9%. Next, global bonds down over 5%, so a very poor quarter for bonds. Global equities down, even gold down. So pretty much across the board, things were negative. Why did this happen then? Here we go. Whenever you see bond prices falling, as we did, I showed you that 5.3% loss for bonds in Q4. Whenever that happens, it signifies that investors have increased their expectations for where interest rates are going to be in the future. Higher future interest rates means lower bond prices today. And that's precisely what happened in December. What we're showing on this chart here, this is looking at where do investors think interest rates in the US as set by the Federal Reserve, where are they going to be come the end of 2025. And essentially since 2022 and that big inflation shock we have, central bankers, governments, you and I as investors, we've all been trying to work out where is the neutral level of interest rates, critically in the US economy, given its size, its importance, but also elsewhere. What is the level of interest rates now that is going to keep economies ticking along nicely, keep inflation under control, but not crush economic activity? Because we all know that if interest rates are too high, then suddenly it's very hard for us to do much other than service our debt. As I say, what is the neutral level of interest rates? Well, in the third quarter, when you see this line going down after peaking in, say, May last year, it starts to come down in the third quarter, and that is because we saw the US economy slowing. The number of jobs being added by the US economy was coming down. The unemployment rate, consequently, was going up and it ticked above 4%. And everyone said, you know what, where interest rates are today at 5%, that is too high. They need to come down. So expectations for where we'd be come the end of this year, 2025, they got right down, you can see there, to below 3%. Then what happened, however, in Q4, suddenly the data started to surprise to the upside. The economy started adding more jobs more quickly. Other variables led us to believe that, in fact, interest rates don't need to come down that much. The economy is doing pretty well. You add to that an unpredictable, as I say, 47th president of the United States. There's expectations that given his pledges to increase tariffs, that will be inflationary. Combating inflation will require higher for longer interest rates. And so the expectation of where interest rates will be come the end of 2025, the line there, it went back up. That hurt bonds. And also as bond yields rose, so that hurt pretty much every other investment class. Because of course, you can get more on US Treasury, then I need more by way of compensation to take the extra risk of going into equities. So high yields means lower prices, not just for bonds, but pretty much across the board. And that is what we saw in Q4. I told you that, the data had improved. Investors had started to think, look, interest rates aren't going to come down as much as we thought in 2025. All of that was finally confirmed by the key individuals, those technocrats at the Federal Reserve who spend their whole day thinking about where that neutral level of interest is. They came out and they said, you know what? In September 24, we thought interest rates going forward would look very much like that lower line, i.e. they'd be coming down quite significantly, coming down to around 3.5% come the end of 2025. All of a sudden in December, confirming what markets and investors had started to suspect, they came out and said, no, actually, we now think the line is going to look more like that higher line, i.e. higher for longer interest rates. So the Fed ultimately came out and just confirmed what investors had feared, that we're going to have higher interest rates and that therefore the kind of declines in asset price we've seen, they weren't wholly unreasonable. So that's what happened in the fourth quarter. In terms of our core views, there has been very little change. As I say, it takes more than a slightly egotistical president to change our views of how the world works. What do we think? We're still slightly underweight equities. The S&P is about as expensive today as it has been at any time this century. I'll show you more on that in a moment. In terms of fixed income and cash, the second rectangle there, we're about neutral. Bond yields today are about as high as they've been this century. And again, I'll show you that. That makes bonds attractive. Now, of course, there are still question marks over inflation. And for that reason, we're not overweight, but we are neutral, as indicated by the horizontal arrow. Final rectangle there, alternatives. Things like select property and infrastructure shares, also areas like private equity, private debt. We like these areas, and therefore that's one of the key areas where we continue to put a bit of extra capital. I said I'd show you what I meant by equities being expensive. Very simple measure here, but nonetheless, it does paint a pretty clear picture. If you look at the 12-month trailing earnings on S&P 500 companies, that ratio where high means you're paying more and more for those earnings, that ratio is 95th percentile based on data from the start of the century, i.e. there's only been 5% of occasions when the US stock market, the S&P 500, has been more expensive. That is the definition here that I'm giving for it being expensive. That is a cautionary sign for us, and that's why we're slightly underweight. On the flip side, when you look at bonds here, you'll know bond yields at 84th percentile. I should note here that here being high is a good thing. You want a higher yield. You want to put your money into high yield, high returns things. And guess what? US 10-year government bond yields, they've rarely been higher this century because they're currently standing at around 84th percentile. So that's me saying that bonds look reasonable value. Now, bond yields went down in the third quarter of last year. That was great for most asset classes. They went up in the fourth quarter. Suddenly, this is bad for asset classes. I'd suggest to you that as these things move around, as we search for what the neutral level of interest rate is, there's no reason they shouldn't next go down in Q1 this year. That's wholly possible. If you think about it this way, we don't know exactly where interest rates are going to go over the short term, but we do think that at 4.5% today, 4.5%, US interest rates are more likely to go down than they are to keep going up. And why do I say that? Well, some of the indicators I'd point to would be, for example, the housing market. There is very little activity in that key market. You don't want to be a real estate agent at the moment because people are not buying and selling houses because interest rates are so high. So that's one indicator that interest rates are high. The next market would be, the next data points I'd use would come from the labor market, where if you look at things like people voluntarily quitting their jobs, that's come down. It's no longer so easy to find a job in this interest rate environment. Similarly, average hourly earnings, they're starting to come down. because again, there's less competition for workers because companies are now a little bit more nervous about expanding in this kind of an interest rate environment. So add those indicators to this next one, this very simple one. Look at what has been happening to inflation. Yes, it is still higher than official targets, which are closer to 2.5%, but look how far it's come down. That is in large part the result of interest rates. And if interest rates are causing inflation to come down that much, they must be pretty high. They must be restricting quite a lot of activity. You add those things together, that's why I think interest rates are more likely to come down from 4.5% than to go up by, say, another 1%, 2% from here. And that, therefore, again, underpins our view on bonds. The final point I made was around alternatives. And again, I'm just going to use a really simple measure here to try and paint a picture of why we believe these things. If you look here at global listed property companies, if you look at the dividends they're paying and compare that to the dividends you can get on equities, so it's a ratio of one to the other, where this line going up, that means you're getting more and more by way of dividends from your property companies relative to your general equity companies. Well, you can see there, the line is 99th percentile. In terms of data from this century, the last 25 years, now is the best time to buy property companies relative to general equities in terms of the extra dividends you are going to collect. Now, you have to make a view on how sustainable those dividends are. We do that kind of analysis. But this, again, a simple way of showing you that some of these unloved areas are looking pretty attractive relative to global equities, which everyone has fallen in love with, the likes of Nvidia and the other Magnificent Seven stocks. Bring it all together then in terms of the economic outlook. The economics, the growth outlook, it looks reasonable. Huge question marks, particularly around tariff policy coming from America. But as things stand today, the economic outlook looks reasonable. And you add to that the potential for falling interest rates. That tends to be good for financial assets. Second circle there, valuations. Valuations I've just been through. Some of the areas that look more and less attractive. Overall, I'd say we're not anticipating another double-digit year from global equities. They've been on an absolute tear over the last 2 years. But nonetheless, when you think about where interest rates are, where bond yields are, they're pretty decent. They're way above the kind of norms that were established post the global financial crisis. So on that basis, we're not expecting double-digit, but we think returns should be reasonable from here. I'd also say take this new 47th president, President Trump, I should say. The one thing we would anticipate from him is volatility, uncertainty. In that environment, cash yielding 4.5% in dollars is not a bad investment. So we want to make sure we have all of that. Final circle there, risk appetite. You add all these things together, we're pretty much neutral today in terms of the risk we're taking. Another way to interpret that is that we think the investment opportunity today, so that's what are returns likely to look like, what are we paying today in terms of current prices, we think it's about par. It's a reasonable time to be invested in our view. Okay, next moving on to the funds and returns. Just a quick reminder in terms of the funds, the range. We have a cautious fund. It typically needs an investment horizon of about 3 years. Next, we have a medium risk fund, otherwise known as a managed fund. It has an investment horizon of around 5 years. And finally, a high risk fund, otherwise known as a growth fund. And it has a minimum recommended holding period of 7 years. You can see how they work in terms of an increasing amount of equity as you go up the kind of risk spectrum. That's because equities are more volatile. Sometimes they'll be down a lot, sometimes they'll be up a lot. You've got to give yourself time in the market for those returns to come through. So starting with the quarter, I spoke about most asset classes in dollars being negative. The other key feature of the quarter was the dollar was very, very strong. The dollar appreciates by 6% against the British pound, 7% against the euro, 9% against the Japanese yen, a whopping 10% against the Australian dollar. Strong dollar means when you translate returns into dollar terms, that all of those currencies, those other currencies I mentioned, are losing value. And you can see that therefore in terms of the return from our global cash targets, they were actually negative over the quarter. And that's because global cash, that basket that includes some pounds, includes some yen, includes some euros, it actually fell by about 3% when translated into a very strong dollar. So losses over 3 months. However, add the full 12 months, 2024, and it was a reasonable year with returns ranging between 1.6% for cautious up to 10.7% for growth. In terms of the quarter, why is cautious doing worse than the other two funds? Well, remember, bonds, as I showed earlier, did minus 5.3% in the fourth quarter. And the cautious fund, it is heavily biased to those bonds. That compares to equities during the fourth quarter, only down 1%. So this was a period, as shown here, when in fact, very counterintuitively, you wanted to be in those higher risk funds with more exposure to equities, which did relatively better than bonds, which, as I say, did very poorly, down 5.3%. Markets were falling. Did we manage to add some value through things like our tactical asset allocation decisions and managed selection? Net, if you look at the at the column on the far right-hand side, that's telling you that overall, no, our decisions were negative overall over the quarter. Asset allocation, which tends to be on the left-hand side of the chart, things like our fixed income allocation were there. The columns are pointing up. That's because we added value through our asset allocation decisions. But over on the right-hand side, when we look at how our managers did during the quarter, managers generally underperformed across areas like fixed income, like property and infrastructure, which we call real assets, and indeed within the equity space. They didn't manage to keep up our managers. That happens from time to time. We're much more interested in how their returns look over longer periods like 3 and 5 years. Add those things together and net our decisions cost around 0.4%. This is looking at managed as an example. A quick note on longer term returns. It's a quarterly presentation, but we should never forget the long term. If we look here, managed growth doing what they were designed to do. Cautious at the bottom there, a little bit behind now its target return in the corresponding dotted line. It's close to it, but it is a little bit behind. It has work to do. With cautious, it has a minimum recommended holding period of 3 years. Now, if you look at its performance versus its target over periods of 3 years on a rolling basis, and you say how often has it met its target, or how often has it been close to its target at least, and I define being close to your target as within 1%. Well, on 74% of occasions since inception in 2008 and One Health 3 years, 3/4 of the time, 74% of the time, it has managed to either meet its target or be close to it, i.e. within 1%. Where we are today is quite clearly from this chart the most significant period of underperformance relative to that cash target that we've experienced since inception. Why is it? I keep making this point. It is very clear. Bonds have lost -5% per annum over the last 3 years. In that context, while we're not happy with it, but our return of -3% per annum, you can see what's been dragging us down. It is those bonds. And in fact, we've done quite a bit better than those bonds. Over 5 years, bonds have returned -2% per annum, whereas cautious is now slightly positive. So again, it's being hurt by this big underperformance global bonds. It has done somewhat better than that. Now, bonds have been atrocious in this most recent period, but remember where we've come from. We've come from bond yields at 0 up to today, bond yields materially higher and offering decent real returns. For bonds to deliver the same weak returns from this starting point would require interest rates to go up by another 4% from current levels. I can tell you, I think that is extremely unlikely. Here, finally, then we just look at returns over the minimum recommended holding periods. Again, cautious is where the real pain is over 3 years, that context of poor bonds. We've also underperformed the peer median over that time period. I can tell you that in terms of since inception versus peers over rolling 3-year periods, we either meet or are very close to the performance of peers, again, using that 1% margin on 85% of occasions. So this is an unusual outcome. It's one that is down to us seemingly having more bonds, maybe having less in US dollar denominated cash than these guys. That's worked clearly in their favor. History, however, if you look at our returns versus peers since inception, it would suggest that our more diversified approach will outperform peers with a structural regional / currency bias, i.e. putting all their money in dollars. We would expect to do better over the long term. That's what our track record since 2008 demonstrates. I'm going to stop there. Some important notes for you just to quickly look at. And then for me to say a big thank you for joining us.
Thank you, Richard, for a detailed analysis and providing us with a comprehensive outlook for 2025. Your views on the post-election landscape gives us so much to think about as we navigate the opportunities and challenges ahead. That wraps up our quarterly bulletin. We know how valuable your time is and would like to thank you for supporting Equilibrium Investment Management and for joining us today. We hope you found this webinar insightful. Until next quarter, goodbye.